Hello, everyone, and welcome to another Wall Street from Main Street podcast. Today, joining me will be a returning guest, investment manager and analyst from the Morgan Report, Chris Marchese. Chris, welcome back.
Great to be back, John.
All right, so first topic I want to get into is other than silver, one thing I hear analysts from the Morgan Report talking about is China. And I was just wondering, they just closed out their China economic meeting. What are your thoughts on it?
Well, regarding the change in the one person or one child law, I don't know. I'm still kind of contemplating it because, in a way, it was a good thing because Mao Zedong, he believed that labor or manual labor was the way to be the most productive instead of capital. So he overpopulated it, as everyone knows. And I haven't looked at the numbers in depth enough to know if the one child per couple law really worked to reduce the population. But in any case, I think it will. The population will adjust over the next several generations. So it's not bad.
All right.
And did you have anything in particular?
Oh, no, go ahead. I thought you were finished.
Then the pollution controls, that's probably, that's a big thing in terms of its effect on the resource market. So when they pass pollution controls, meaning that cars will have to have catalytic converters, which are the primary uses of platinum and palladium.
Yeah, platinum and palladium, they look to be in the fundamentals look strong. Out of all the metals this year, despite the takedown, palladium is really held up. What are your outlooks for palladium next year? And platinum?
Oh, okay, I'll start with platinum. In the U.S., auto sales, they're as easy to get, or loans are as easy to get as mortgages were in, the 2000s. So you basically just need a face. And so, auto sales have been doing well. And those, require a lot of platinum and palladium. And again, with China starting to use a lot of platinum in their cars, that'll be another big boost to the demand side of the equation. I mean, car ownership, with regards to the population, is comparable to the U.S. in the 1920s. So there's a fair amount of cars that will be sold. And on the supply side, that's pretty it's interesting because, as most people know, there's been a lot of labor strikes in South Africa, which almost all palladium is mined, 95% or so. And they're demanding wages that make mining platinum uneconomical at these prices. So the price will have to move up in order, for the markets to clear and for this growing supply deficit to resolve.
Mm-hmm.
And, it's also people like holding it as well as gold and silver, for investment, not nearly as much, but to some degree. And palladium, for demand, it's the same reasons as platinum, except that, there's a lot less produced, and about 15-20% comes from South Africa, and the rest comes from Russia. And I just discussed the problems with South Africa, and in Russia, Putin usually holds back some of the production and stockpiles it. So, the supply side is very good, and the demand side, given the amount of palladium that is mined, is still, I think is more bullish in platinum, at least for the next year or so. But, both metals should do well.
All right. Well, and the one other thing is, I was just wondering if, in terms of demand, you talked about the Chinese auto market. One thing China also said was they're not going to add to their foreign reserves. Do you think this means that China's purchasing power will rise, and that will also increase the auto demand and put more price pressure upwards on platinum and palladium?
The purchasing power won't rise, unless you include increases in productivity or some type of technological revolution, because it's pegged to the dollar. And I think, the only way it could, the purchasing power of the yuan or the RMB could rise is if it depegs, which it would never do, in an immediate manner. It would probably be done over years and in phases. So I don't think that will contribute, but China overall has a 50% savings rate, as of December 2012. But remember, savings in terms of economics is, cash in the bank, all that, plus investment. So, they got a lot of capacity to grow, and the urbanization of China is inevitable. So that's, the demand driver is really strong. And in terms of foreign reserves, they haven't really been adding to foreign reserves. They've just been letting them mature and not rolling them over. And I think that's the smartest thing to do, at least in the short term, as to not disrupt the dollar.
All right. And speaking of the dollar, this one person or this one entity, I'm sure there are good reason of why they don't want to add to their foreign reserves. The Janet Yellen, she'll be coming in and running the Federal Reserve next year. This is a two-part question. One is, what will a Janet Yellen Fed look like to you? What do you think it has in store for us? And can it actually taper?
Okay, the Janet Yellen Fed, it's going to be interesting. It's probably going to start off more or less the same as the Bernanke Fed for the first few months at least. And then I expect her to increase asset purchases, but not treasuries, maybe mortgage-backed securities, but potentially auto loans, student loans, which have started to go. There's a lot of problems starting to arise, and so maybe some uni bonds. So the real thing I think she'll do to kickstart the economy, because she believes, she's a Keynesian. She doesn't believe in stagflation. So she's actually, in her paper, I'll summarize what she said, but it's basically inflation can't exist while there's excess capacity in the economy. So that's basically what happened. It goes opposite of what happened in the early 70s versus stagflation. But all these FOMC members, they've never worked in the real world. They're all academia, so they have no idea. I mean, having academics work for something as important as a central bank is should be only people that have accomplished something significant in the real world, not these people that just graduated from Ivy League schools, which I think is actually a bad thing, to be quite honest, just because they're so Keynesian and they're so in tune to what with the state preaches. So I think Janet Yellen at some point, possibly in late 2014 to early 2015, aside from asset purchases, will start charging banks on excess reserves, which will make them lend. Or not make them lend, but they won't want to hold them if they're being charged on excess reserves. So if there's more money circulating in the economy, then economic growth is going to artificially pick up. So I see that as a very real possibility, especially because she's not worried about inflation.
Yeah, I was wondering also, you were talking about Keynesian and how they're not in the real world. Would you agree with me the biggest flaw of Keynesian economics is that they think they could move, they think it's sort of like, I don't know, when I played sports there was like an X and an O, and if you move X here, O is going to do this, and then you move this X here, and this is what happens. But that's not how economics works. You're dealing with people. And would you agree that's the biggest flaw in that you can't predict? Not everyone's reaction is very similar.
Oh yeah, definitely. That's I'm a student of the Austrian School of Economics, and Ludwig von Mises, widely considered, the most accomplished Austrian economist in terms of his additions to the theory, are that he wrote a book which is really his treatise called Human Action, and it's really all about how econometrics can't work, and such things as the Keynesian models, the monetarist models, are useless because you can't forecast human action because it's ever changing. Yet the market can adjust to it, but we don't really have a market, as I'm sure you know.
Yeah.
And another big problem with Keynesian economics is their inability to understand time preferences and the implementation of that into their models. Oh, and going back to the second part of the Janet Yellen question, could you repeat that really quick?
Well, what will the Fed look like? If you have anything to add to that, and can they actually taper?
Well, I mean, can they actually taper? That is all dependent on what you mean by taper, because what they're doing now is they're buying mortgage-backed securities because a lot of them are still junk, and buying treasuries. But I think that treasury buying they will definitely taper that and potentially increase purchases of mortgage-backed securities, and maybe even completely taper treasury purchases, because when the Fed is only buying mortgage-backed securities from the banks will then buy treasuries. So it's a way of kind of going around the obvious in terms of asset purchases and monetizing the debt.
So like a hidden in plain sight.
Yeah,
Treasury debt monetization.
because so as a lot of risk is being taken off their balance sheet, they'll be able to buy the treasuries. So the market won't think that the asset purchase program is big, nearly as big as it really is, because banks, they are a government entity. The Fed, I mean, I know you can, people claim it's private, and technically it is, but who appoints the Fed chairman? The president. So there's obviously they're working together. There's, I don't know, it's absurd. And, it's pretty apparent if you look at just the actions of the Fed. And if you look at all the holdings of the commercial banks, which you can find online, their treasury purchases have started to increase over the months. So I think they're already transitioning to what I said.
So just the one thing is one thing the Morgan Report's very famous for is gold and silver. What will this? What's your outlook, and what will this mean for gold and silver?
In the short term, I think gold will test or potentially, break its June 28th lows, and maybe, test 1,000, 1050. But, I think silver will hold just because of the supply and demand fundamentals. And given the gold to silver ratio is trading around 63, which is, just absurdly high. But so I think silver will test or come close to testing the June 28th lows in December. And then after that, the first quarter of 2014, I think the metals will consolidate again at, maybe even lower levels than we've seen. But, going forward in 2014, I think that both metals will move up, not to a significant degree, but starting in 2015, I think that'll be the beginning of the next leg up. And I could see 2016, 2017 just being, one of those years back from the 70s in terms of, how many it could increase, several fold.
Oh, all right. So basically, you think the second half of 2014 will, when it breaks out of the slump?
Well, maybe I would say first part of 2015. I mean, I think it will move up a little bit in the second half of 2014.
All right. So, and one investment you really like is zinc. Can you tell people that who are unfamiliar with it?
Sure. Although it's a base metal, at which, as a whole, we and I know many others aren't particularly bullish on. Zinc has great fundamentals in terms of China being the primary consumer, and more so on the supply side. There's a wave of massive primary zinc mines that even this year have started to go offline, with Brunswick 12, Perseverance. Then going forward, I'll just name a few because, there's that many out there, but Lachine, which is the biggest primary zinc mine in Europe, and it's in Ireland. And then the Century mine, which is largest primary zinc mine in Australia and one of the largest in Asia. So through 2016, 2017, there will be a good amount of supply coming offline, and in some part of 2014, in the second half, there will be we will enter a supply deficit whereby annual consumption exceeds annual mine production. It doesn't mean that it's not inclusive of above ground inventory supply.
All right. And any other sectors you have your eye on, or?
Oh yeah, there's a bunch. Energy, just even broadly speaking, in terms oil, gas, uranium, geothermal. And let's see, agriculture. I mean, there are a few things to like there as well, and I don't want to say any of them, just because those are for our members. But
okay,
I mean, the whole commodity complex, you're not going to go horribly wrong, relative to investing in something like government debt or even trying to invest in high quality companies at these levels. I mean, the Dow hit a new high, the S&P hit a new high. I think the NASDAQ just hit a new high. So, I think those are just very dangerous at this point, even though there's these absurd market commentators coming out and saying, there's a long way to go. And, there really isn't. I mean, the earnings, they're just, the fundamentals don't work out.
So, do you think the stock market's in a bubble?
I don't know if it's in a bubble. I mean, because of how much has actually been printed. By printed, I don't mean injected into the banking system, but the money that's actually made its way into circulation, which has grown on average between 8 and 10% over the past several years. And you can see it in the increasing prices of filling up your car or going to the grocery store and those types of things.
All right. So